Good morning, everyone. Thank you so much for joining us. And today we're excited to present a special webinar, educational webinar about strategies for employee retention credit success. And today we're so excited to welcome expert Kevin Bryce from Employer Incentive, who will just share phenomenal knowledge about this employee retention credit program. There's so many business who can benefit from this. So we are truly thankful for our speaker today who take time to share his vast knowledge on this important topic. And we're also so excited to have a chance to collaborate with our fellow chamber partners and Maryland Hispanic Chamber. And I would like to invite the chairman of the Maryland Hispanic Chamber to say some welcoming words. And thank you, Marco, to partner with us and support this program.
Thank you. Thank you so much. And thank you for the invitation. I'm really excited to start our partnership between the Asian American Chamber and the Maryland Hispanic Chamber of Commerce. One of the goals that we have is to be able to collaborate with different organizations and be able to help each other, and reach out to a wider audience. So we're excited to start this partnership, and I'm looking forward to many events in the future. Our chamber's been growing, and for the past 3.5 years. I think we grew about 800%. We are from 89 members. We are, as of today, we have 1,100 members. And this happened organically through the growth was about 450 and change, but then we've been signing MOUs with the smaller organizations that are under the umbrella of the Maryland Hispanic Chamber, like the Guatemalan Chamber of Commerce, the Salvadorian Chamber of Commerce. We created this associate membership, and now we are double. And then partnerships and collaboration like this one here kind of goes a long way, and we're able to cover and help each other more. So thank you for having me. I'm really excited about this, and I'm looking forward to working with you all in the future.
We truly appreciate you, Marco, and just phenomenal leadership. You really transformed the organization. We so look forward to working with you in the future to co-host more events and support each other. So next, let's welcome our speaker today, Kevin Bryce, Employer Incentives. Recently, they were so generous sponsoring our Juice of Asia Chamber Awards Gala. Their support of the Asian community is incredible. And we want to say another thank you to you for your generous support. And today, now that's it, welcome Kevin to give a presentation on employee retention credit.
Great. Well, thank you so much, Cindy, for that kind introduction. My name is Kevin Bryce. I am the Vice President of Business Development with Employer Incentives, and I will be taking you through this presentation today. And just to give you a little bit of background, and to give you a little bit of a just something about my day this morning. Well, not this morning, but for the past week, I've been fighting off bronchitis. So if you guys notice me like my voice changing a little bit or getting a little rocky, that's why. I've got all my drinks in front of me, so I should be able to make it through. Just please bear with me. And yeah, so my presentation today is called Strategies for Employee Retention Credit Success. We're gonna walk through some of the basics about what the employee retention credit is. It's sort of the talk of the town as far as as far as business tax credits and reimbursements go. We work very closely with a lot of tax credits. We're sort of laser focused on that part of making the bottom lines of business owners improve. So we work with that, for the last 20 years, we've been laser focused on that aspect of it. And this tax credit, this refund is certainly, the biggest sort of windfall tax credit that we've seen in a long time. So without further ado, let me jump right in. And please feel free to, interrupt me if you want to throw hands up, or if you want to, add anything or ask any questions. I'll have questions at the end, but if there's something that you really want to ask while I'm on the topic, I certainly don't mind that. I don't know if you guys have rules against that for the presenters, but for certain, it doesn't bother me. Okay, so just to give you a little bit of background about employer incentives and why we can claim to be experts in this sort of field, we've been doing this sort of work since 2000, basically since work opportunity tax credits became a thing. Work opportunity tax credits are a way for business owners to sort of be refunded. Not refunded, it's more of a credit, but it basically is if you have a group of employees who qualify for this credit because they're a member of a group that's been disenfranchised in some way, or food stamp recipients, people who are on public assistance, a work opportunity tax credit will reimburse you some of that that public assistance, because the government no longer has to pay it if you gainfully employ these folks. So we sort of laser focused on tax credits once that was developed, and we do all other sorts of tax credits, but we've been in this business since 2000, and it's been really lucrative. And then as part of our business, we sort of have our radar up. If there's any changes to that landscape, if we determine that there's any really lucrative tax credits, we offer it to our clients, and we do reach out. And the employee retention credit has been like a monument. It's been like a paradigm shift in our business because of how it can help. So basically, we started offering this service back in April of 2021, and since then we've had over 1,200 businesses sign up for our service. We've saved them collectively over $200 million, and we're still managing that process. Okay, so you might know what it is already, but for those of you who don't know, this is what the employee retention credit is. So it's part of the CARES Act. The CARES Act was put in place to sort of assist businesses who had been damaged, or who had been, experiencing loss of revenue, who had been in some way detrimented by the pandemic. So back in 2020, the employee retention credit was brought up, and it was implemented. However, it wasn't 100% useful, because at that point you could either have the employee retention credit, or you could have a PPP loan, and you couldn't do both at the same time. So it was a little bit difficult for companies to manage. I know PPP loans are, it's on the tip of everybody's tongue. Everybody knows what a PPP loan is. Many companies took advantage of that program. Small Business Association put out, thousands and thousands of these loans, and the employee retention credit kind of got tucked away, and people didn't really pay attention to it because you could do one or the other. And the PPP loans were fully forgivable loans, so everybody decided to jump on those. However, in 2021, the new administration said, okay, we're going to make the employee retention credit more usable We're going to go back and we're going to expand it. So it's become a lot better. And essentially what it is, it's a calculated percentage of the first $10,000 in earnings that your employees make. And it's basically a refund that the employer receives. So it's the employees don't get anything, but the employer gets it as a way to offset the cost of the damage done by the pandemic to your trade, to your livelihood as a business owner. You can qualify for the program in 2020 if you have under 100 employees. And in 2021, they expanded it to include businesses that have under 500 employees. And it's the amount of the credits are pretty substantial. So it's 50% of the first $10,000 that an employee earns in 2020 altogether. In 2021, again, bigger and expanded, it's 70% of the first $10,000 an employee earns per quarter. So the maximum that you can get based on those numbers is roughly $26,000. However, there is a bit more to it that allows you to get $33,000, but only very specific circumstances are at play. And that's why that maximum benefit of $33,000 has a little asterisk next to it, because it's almost impossible for companies to get that. Now, you may hear, companies that will get you, we'll get you $26,000 per employee. You've got to be really careful there. Because the idea with this credit is not to get the maximum amount, it's to get the correct amount for your company. Okay, so we never promise that we'll get companies, we do these credits all the time. We never promise that we'll get them the maximum credit, because that wouldn't be appropriate. It's the amount that's appropriate to calculate per employee for the company. You have to make sure you qualify for the quarters first. There's a whole process. However, if you're looking at what the benefit could be, if you want to see that as sort of a calculation, then you could say $26,000 times the number of employees that you have. And there's limitations on which employees you calculate as well. But if you want to get a general idea of the sort of numbers that we're talking about and why I consider it a windfall tax credit, that's what we're dealing with. Right. So it's the other thing is the employee retention credit. So you have to have employees to be able to participate. Okay. So now we're going to talk about which kind of companies can qualify for this credit. Okay. So qualifying for ERC, the very simplest way to qualify, the most black and white, is to qualify based on a significant drop in revenue gross receipts. So in 2020, if your business had a shortfall of gross receipts of at least 50%, you made 50% of what you typically make when you compare to pre-pandemic numbers, which is considered 2019. Basically, we're comparing everything to 2019 because 2019 is typical business. It's pre-pandemic. You haven't had this huge monumental, shift in society. And that's what your typical business would be considered. So we look back to 2019. If in 2020, your business had a shortfall of 50% compared to 2019, then your business qualifies for the credit. So there's that one threshold. And then throughout quarter by quarter, we measure quarter by quarter, the business remains qualified until that shortfall comes within 20% of your 2019 numbers. So if you're down 50%, you qualify or more. And then if you came back a little bit, now we're at 40%, you're still qualified. 30%, you're still qualified. You qualify until you rebound to within 20% of your 2019 numbers. Okay. And the good news is your business can claim the rebound quarter as well. So the quarter that you came back is also eligible for the credit. Now in 2021, like I said, a little bigger, a little better. The threshold rule, okay, is 2021, if your business had a shortfall in gross receipts of at least 20%, and that's it. 20%, 20%. As long as you are you're down 20%, then you qualify for the program. So there's no big threshold to work through. So compared to 2021, you're compared to your 2019 numbers, 2021, if you're down 20%, you qualify. All right, and we're comparing gross receipts as the appropriate number. Not-for-profits qualify for this as well. So if your not-for-profit organization was down in whatever comparable metric you would have to gross receipts, then you can qualify for this program too. Okay, so that's the most obvious and most black and white way to qualify. Now, the next way to qualify is also pretty black and white, and we're going to talk about being a recovery startup business. All right, so a recovery startup business means that you began your business, you started your business after February 15th of 2020, meaning, well, and within 2021. You started your business during the pandemic, and I'm using air quotes because everybody's pandemic experience sort of has a different end point, a different, start. But that's what the IRS and the US government qualifies as during the pandemic. Okay, so if you began your operations after February 15th, and that means beginning your operations as you would as a business, not that you incorporated. You could have incorporated in 2019 and not started your business, not opened your doors to the public until after February 15th, 2020. That's okay. So when you started your commerce as intended, that's when the recovery startup business kicks in. Now, you can't have made over $1 million in average annual gross sales in order to participate as a recovery startup business. But if you do qualify, you automatically qualify for employee retention credit for Q3 and Q4 of 2021. And that's capped at a maximum, of $50,000 per quarter. This is the only way that you can qualify for Q4 2021, which is why in the beginning, when I said, what's the maximum that you could get? Well, the maximum is technically $33,000, but we don't often have that situation. So the maximum for most companies is $26,000. Okay. Now, you would auto qualify for Q3 and Q4 as a recovery startup business, as long as you don't have over $1 million in annual wages. I'm sorry, in annual gross receipts. But once you do qualify for that, you automatically get Q3 and Q4. Now, you can also qualify for Q3 2021 for any of the other reasons that we're going to discuss: drop in revenue, or the ones following this slide. But if you don't qualify for any of those other reasons and you started your business after February 15th, then you qualify for recovery startup as well. Okay. All right. Next, we have government mandates. This is kind of fun and applies to a lot of businesses. So it's one of the ways that we qualify, or that we help companies qualify, I should say, because we don't actually qualify anybody. We sort of help you understand the rules so you can make the determination whether your business qualifies. But when qualifying for government mandates, excuse me. So the government mandates, can you guys all see the right side of my screen? I'm just thinking about this. Can you see like the full sentences, or? Yeah, okay, great. So government issued mandates are basically rules imposed by a government authority, either a local government authority, state, something like that, where they change the rules of how you were allowed to operate. This can come in the form of capacity restrictions for restaurants. Okay, well, we didn't allow, if the government doesn't allow any of your indoor tables for the beginning, you can only do takeout as a restaurant, let's say. And that was, that was imposed on you by a mandate from a government authority. And this happened to pretty much every restaurant in the United States. But if the government imposed these mandates on you, you would qualify for the credit for as long as those mandates were imposed. Now, it doesn't have to be a complete closure. Once the government opens your business back up or allows you to open up to a 50% capacity, you still qualify. Because again, the government is still mandating how you're supposed to run your business because of a public health emergency. But they're still doing it, so you still qualify. Then if you go up a little bit more and say, oh, well, now we're open to 75%, you still qualify. Until you're open and you're running your business as you had been prior to the pandemic, 2019, then you qualify for these credits, okay? Now, if you think about other places like, gyms, chiropractors, massage, you're thinking about, salons, all of those things had these kinds of capacity restrictions. Also, it doesn't have to necessarily be a capacity restriction. It could be a timing issue. So there's a lot of companies that were hit with things like, they had curfews put in place, especially in larger cities where they reduced the hours that companies were allowed to be open because they didn't want people traveling, they wanted everybody home at a certain time. If your company had a curfew imposed on it, you had to close prior to your hours that you normally would be open. That is a government mandated imposition on your business and would therefore qualify for this program. And you qualify for as long as those mandates were in place. Now, it can't be a suggestion. It can't be best practices. It has to be like a writ from the government, which again applied to almost every restaurant in the US, almost every gym, almost every place during the pandemic that had an indoor area to go that you couldn't also do via virtual work or anything like that. So your office being closed, if you have an office and you could do the work just as well from being at home, that doesn't count. There's actually a rule that says, well, the time that it takes you to get yourself set up virtually, you would qualify. That is out there. But what we're talking about here are you had to behave a certain way based on an edict. Okay. Right. So that's government mandated closures. Oh, and I want to be very clear about this. You don't have to qualify for all of these things. You only have to qualify for one of them in order to be able to claim the credit. Okay, so we've done 3 slides on how to qualify for this. I'm going to do another one. That only has to apply to to your circumstance once. Okay. All right. Finally, qualifying for ERC, goods and services. Okay, if your business was affected by a disruption in the supply chain. Now, this is I put this one towards the end because it's sort of the most foggy. It's sort of the grayest area that we deal with. And basically, if your business relies on a service or relies on goods that it wasn't able to obtain, you may qualify for this credit, provided that the reason why you weren't able to obtain it is because of a government mandated closure, just like in our last slide, up the supply chain from you. Okay, So if the plant that manufactures the the widgets to create your device was forced to comply with a mandate that reduced their capacity, they had to take half the people off the floor, and therefore it slowed up your production, and you were affected by that. And you were affected by that in a non-nominal way. So a non-nominal way from the IRS is it's a 10% impact, or positive or negative. This would have affected you negatively in a non-nominal way. So your business output, or the hours that your employees work, if you're a restaurant or a sub chain or something like that, would have had to have been affected in a non-nominal way. If these mandated closures up the supply chain affected your output by a non-nominal percent, then you would qualify for this credit. However, this is sort of one that you have to be very careful with, because you have to be able to show that mandate applied to your supplier. You had to have made a good faith effort to try to get your supplies from a different vendor, and they had to have resulted in this, larger than nominal, a non-nominal percentage of a decrease. So there's a lot that has to be proven there. But then also, from a services perspective, which is the next bullet down, if you were unable to meet with your clients face-to-face, and not meeting with them face-to-face provided that non-nominal reduction, then you can also qualify. And this goes for people who, manipulate limbs for a living. We're talking about physical therapy. This is also for people who do home health care. If you're a home health care operator, you could see that, or when you're getting new clients, you do an evaluation process where you try to find out what they can, how they move, what they can lift, how they can operate, the basic motivations of their lives. Are they able to, to toilet themselves? Are they able to do simple household chores? Are they able to feed themselves? Those kinds of things. And a lot of that is an in-person evaluation. If you have to evaluate people in person and you are unable to do so, and you can legitimately say that your business was affected by a non-nominal percentage, again, 10% negative impact, then you can qualify for this credit. So there's really a lot to consider. And I have this impression from talking to a lot of customers who, who their CPA doesn't know enough about the process or something. Oh, I was told that I don't, I didn't lose enough money during the pandemic, so I don't qualify. That's one of 4 potential qualification methods. So you really have to be careful, and you really have to do some analysis, and you have to know something about the program to determine whether or not you qualify or not. So you really should be careful. Along with being careful in this way, I want to also put up some things to look out for. And this is because this program has gotten a lot of attention lately. And a lot of that attention is coming from reports that there are businesses that are sort of popping up to take advantage of this program and to, help people through it, but then are taking their money and running. So let me throw up some red flags. Employee retention credit is considered one of the most frequently mishandled of the IRS refunds that are out there. So it takes a lot of knowledge to kind of work your way through it. If that business has just come into being in the last 10 years, are they going to be around? So if you're trying to find out if a vendor is right for you, make sure that that business has been around, and will they be around in the next 10 years, or are they just going to, do this for you, take their money, and, to hell with the consequences? You have to be prepared of that. And the reason why I say 10 years is because the IRS is looking at this, and they're saying, okay, well, normally you have to keep your paperwork for 7 years for backup purposes, for, in case of audit and that kind of thing. However, for these credits, you have to keep it for 10. And that's because of the, the scrutiny that it's currently getting. Be aware of people who are asking, or who are telling you that you can get the maximum refund, or that they're saying you can get this refund, and you're already qualified. No, you're not already qualified. Those people who aren't doing a thorough analysis of your business with you and are telling you that you're qualified, that's problematic. Okay, it takes you have all of the information about your business. It takes a lot of analysis. It takes a lot of discussion to determine whether or not you qualify. Some of the stuff is easy. If you had the revenue drop, great. But other qualification methods, some of these grayer areas, those require a little bit more thought. If you're receiving, a lot of robocalls, if you're getting people on the phone who can't answer certain questions about the program, these people are calling you from call centers, and they're just trying to get you to say yes to an agreement so that somebody else can do this work. They might not be able to tell you how much they charge right off the bat, if they charge for the service. And some companies want over 20%, 25% is a very typical number. We don't see upfront charges a lot. I have seen people that do it upfront, that charge upfront, regardless of how much you may or may not get. So just be careful that there are bad actors in the space. And I've prepared this. This is a questions to ask a potential vendor. Just to sort of weed out people that aren't going to have your best interest in mind. A big factor of that is, will you work with the IRS on my behalf? Okay, the IRS is inundated. I spoke to a rep maybe a month ago, and they said they had over 800,000 returns that they had backed up. So they're going very, very slowly. They're going through these returns as quickly as they can, but they're making a lot of mistakes. And we see a lot of the mistakes over and over again when we deal with the IRS. We have a very good relationship with the IRS. We're starting to know agents by name when we pick up the phone. Hey, it's you again, because we deal with the IRS. It's become the primary mover of our day. And essentially, they are so backed up that it's taking 6-7 months to get through the process. And when they do, sometimes they're putting things in the wrong column. It's difficult. So we work with the IRS to make sure that things go well, but not every company does. So when you're working with a vendor, find out how they deal with issues, or are they, they just send the paperwork to you for you to sign, and then that's it for them. Make sure that they're able to provide your accountant with everything that they need to back up. The accountants are often involved in this process. ERC, returns require an accountant to go back and refile the quarterly, we refile the annual returns for 2020 and 2019 with the new profit numbers. You know, depending on when you get your checks, that year you got interest that needs to get filed because it's a taxable refund. It's all profit, but it's taxable like any profit would be. So you have to make sure that your accountant's involved, and if you know they can't give you the calculation or how they got to those numbers, you got to be careful. And do you offer backup in the event of an audit? That's also very important to know. Okay, now let's talk about how you go about claiming employee retention credit. So number one, determine which quarters you qualify for. You can only qualify for quarters between 2020 and 2021. And you can only qualify for the very end of quarter one 2020. All right, because quarter one 2020 was the very start of the pandemic. And most companies shut down around March 14th to 17th, somewhere in there. So what the IRS does is they're saying, oh, well, we'll just combine the quarter two and the quarter one 2020 941X together, because we don't want to have a bunch of pennies and, and small numbers to deal with on the quarter one 2020. We'll just smash it together on the quarter two 2021, quarter two 2020 941X. So the first thing to do is determine which quarters you qualify for. Okay, and they could be for any of the four reasons. It could be for one reason for this quarter, a different reason for the next quarter. You have to make the determination of how you qualify. Okay, make sure to keep any justification that you have for qualifying for these credits for, like I said, 10 years. Okay, just put it on a shelf somewhere, right? ERC on the side of it, say this is why. Okay. Then you need to calculate the correct amount of credits per quarter. Okay, now there's a bunch that goes into this, where first of all, if you're the business owner and you take a paycheck, your wages do not qualify. If you are and I can help anybody with these calculation questions or anything like that. My number will be at the end of this, but just to give you a brief idea. If your family works for you, for your business, their wages don't qualify if you're the majority owner. If you're related and you own a company 50-50, that if you're related to you and your sister own it or whatever, those siblings they get counted as 100% owners, so they don't qualify. So there's a bunch of rules where you take people out of the equation. And then also you have to remove any PPP loan that you use to pay for payroll from those wages as well. From the start of the PPP loan to when you finish paying it off, or when you finish paying out the wages for it, all of that needs to come out. Now, that's only if you got the PPP loan fully refunded. If it wasn't refunded at all, you don't have to. You can just leave that part out. But just be aware of what percentage you used for payroll of your entire PPP loan, because that will be important. So then mechanically, you have to complete the 941X worksheet and the 941X for all qualifying quarters. You have to, sign the back. Make sure that when you're signing the back of these forms, that you're putting the proper information and the reason why you believe you're qualified. And then you send these forms, 941Xs only, to the IRS. And I'm happy to provide the address to the IRS that you should send them to. But keep all of the worksheets for your records and put them in that binder. Okay. Your checks will take about 6 months to arrive. The IRS is processing a ridiculous number of refunds. And but the benefit of waiting that long is that the IRS has to charge themselves interest on refunds that take over a certain amount of time. So those refunds, we calculate a certain amount for our customers, and then the checks end up coming for them. They usually get maybe a few $1,000s more because the IRS has had to charge themselves interest. You have to make sure that your accountant knows that you've received checks so that they can add it to the proper quarters. And when you receive your checks is important because the interest is taxable in that year. So you have to make sure all those dots connect. And then after that, there's no limitations on how to spend the money. So as long as you've taxed it properly and you've accounted for it in the right year, it's profit to your business. So you can use it to make capital improvements. You can use it however you wish to use it, however you would normally use your profit. So it's definitely worth it. It's definitely worth it to do this. But you just need to make sure that you can substantiate your qualification. All right, and then the one other thing too is what we've been experiencing with the IRS a lot lately is you need to make sure that your 941s for 2020 and 2021 have been filed. We've been running into this a lot where we call the IRS because one of our clients, their 941X hasn't been processed, they haven't received their checks. And the IRS agent will say, well, they need to have their 941 processed before we're able to put in a 941X on that account. Well, yeah, 100%. But so you got to make sure that all of your existing 941s are taken into account. And if you have 941Xs for any of those quarters as well already, those need to be incorporated into the new 941Xs that you're sending as well. So yes. So let's talk about just some last thoughts here. CARES Act was passed through Congress. It's legislation. A lot of people will say, you'll hear, oh, it's a scam, or, the way that people treat it with their robocalls and their call centers occupying your inbox. Yeah, it feels very much that way, but that's only because of the bad actors in the field. It's not a scam. This is legislation. There is that, that I don't want to, involve myself in this because of how it's perceived, but that's it. It's just a perception. It is a real thing. Right now, the IRS is taking over 6 months to complete these refunds. You might get lucky. We have some anomalous ones where they come out in 3 months and you're like, whoa, let's, hey, celebrate. But because of the way this is laid out, they do take a long time. Now, the last opportunity that you have to claim for the full benefit, meaning 2020 and 2021, you have to postmark your 941Xs prior to April 15th, 2024. And that's because if you file your taxes by tax day of 2024, your 2023 taxes are considered timely. And that's the last opportunity, 2023, to submit returns for 2020. So because you have 3 years to amend 941s with a 941X. So that's the last opportunity to get the full benefit. Then the last opportunity to get any benefit, meaning 2021, is the same. It's April 15th of 2025. But there are so many problems on the IRS side right now that you have to deal with those timelines in 5 to 6 month increments. Because the IRS may say, we didn't get the 941X that you send in. We don't have a record of it. Well, if that's the case, you need to resend it in. And then it takes an additional 5 to 6 months. They're not going to rush it because they didn't have it in the first place. The IRS doesn't work like that. It's like I was going to say a well-oiled machine, but we'll just say it's like a machine. You know, once it gets there and they have a record of it, it still takes a certain amount of time. So you need to make sure that you're doing this now or soon. Because yeah, if it doesn't go through the first time, like right now, it's almost August. If it doesn't go through the first time, we're waiting 5 to 6 months before they're able to tell us, you know, yes, we do, or that there's a problem, or you have to follow up with them every 60 days to determine if there's a problem. And then once you determine that there's a problem, you have to reset the paperwork, and then we're waiting another 5 to 6 months. So we only have like 2 of those increments left before we're, you know, at the deadline. So just be aware of that. Yeah, and the other thing too is at a certain point, the vendors who operate this properly are going to become inundated. So, you know, get your returns. If you're interested in the program, you want to use a vendor, find the right one for you, and make sure that you engage them earlier rather than later, because they're going to run out of resources the more people try to pack this in at the last minute. Okay, so now, does anybody have any questions? Can we open up the floor?
Yes, I do.
Okay, Sandra.
Yes. Okay. So I have a corporation in Louisiana, and I do have, you know, my husband and 2 adult children as employees.
Mhm.
And I guess I'd qualify for ERC1, you know, with the drop in revenue,
Mhm.
probably ERC4 with the supply chain issue. Now, because of, I think I heard you say that relatives don't qualify.
That's right. So
so-
it's not, if your corporation is entirely made up of your family,
Mhm.
right, where it's the 2 owners and then you have your 2 adult children or the employees, then yeah, all of your wages, it sounds to me, would be disqualified from the program. So
Okay.
you have to have unrelated employees that work for you to be able to benefit from this.
Gotcha. Okay. So if I have employees that are not, say, in the state, or that are, you know, out of the country, that does that qualify if they get a,
As long as they're W-2 employees,
okay, so,
they should qualify. Yeah, W-2 employees, it's important. They have to be actual employees of the business. It can't be a 1099.
gotcha.
But otherwise, yes, it should qualify.
Okay.
Yeah, as long as the business itself qualifies for one of those reasons, you know, the employees being, you know, out of state, that doesn't weigh into this.
Okay.
Unless they're, you know, it really depends on each specific circumstances.
Mhm.
So yeah, it's worth an analysis. It's worth talking through it. You know, that can really help kind of bring clarity.
Yeah. Yeah. Because like I said, I know there's a lot, you know, like you said, a lot of the robocalls and, you know, the information's kind of, you know, some say this and that. So, well,
Right.
you know, that was pretty much, you know, what I needed to clarify.
Yeah. And there's also some plain language IRS guidance. And Cindy, what I'll do is is it okay if I send that to you and we can distribute that to the people who are on the call? That plain language IRS guidance is really useful because it gives you essentially question and answer scenarios about this is how a business might qualify. And here are 3 examples of businesses that have that situation and why they qualify for the program or why they don't. But it's not in your typical legislation, legalese kind of, you know, page after page of, you know, saying nothing. It's very direct. So I'll send that to Cindy, and Cindy can distribute.
Yes, please. I'd like to ask uh, any guests here, if you officially register, I know we have your contact email. If you see this Zoom link and didn't sign up on website, would you please just drop your email in the chat room? So Duan, Sherman from our office, they can take down your email and we can share more notes from Kevin. Kevin, if you have some really useful tip today, this is so educational. We do have a big circulation, like a database, over 10,000, 11,000 emails. And I think this will be so informative. We can include some nugget there if you can think of something worthwhile to share, because we can utilize our platform to deliver the message. It can be also a series of different topics, because I know it's kind of a little bit messy out there. We constantly receive this type of calls or emails or message from the resource, and then people come out don't know who they can really listen to what is like
I mean, I'd be happy to do that. It does muddy the water when there's a lot of people just like sending you messages all the time. I know a lot of restaurant owners have been absolutely berated by these folks, and it's unfortunate, really.
Oh, thank you.
Sure.
So for you can help a business from any state?
Yeah, we're nationwide. We do employee retention credit for like I said, over 1,200 companies across the U.S. And and we support them. We support them past the initial submission of the forms, and just to make sure that they're getting everything that they're supposed to. And right after this, I'm jumping right on calls with the IRS to to try to figure out the circumstances, why certain companies it's taking them longer than normal, or if there's a problem, where we need to go. Yeah, that's basically most of my days these days, is supporting people after this process. So.
Well, those are some of the really wonderful help you offer to this small businesses. So we had a chance to talk to some restaurant business owners, and today wonderful to learn the different other industries like a home care service, medical service type of a business. They can potentially also benefit. So I know some they will talk to their CPA firm. Is that their own CPA firm? They possibly help them to file this, or
Absolutely. Yep. Absolutely. CPA firms are a good first step. Sometimes CPA firms want you to be really clear about how you qualify for the credit. And that's something that we do as well. So they're a really good step. We work with a lot of CPA firms because this process is a lot of work. So a lot of times we'll get referrals from CPA firms to help their clients out. We work with a lot of them to provide us with a lot of referral business. So yeah, absolutely. Go to your CPA firm for sure.
Wonderful, great to know. Oh yeah, we have 4 minutes left. Do we have other questions from other guests?
Kevin, quick question on does your firm when you work with a company, your fees are based on the number of employees, or is it a flat fee, or how does that work if somebody wants to come in and say, hey, I need your help?
Yeah. So our fees are, we don't charge anything up front. And then what we do is when you receive your benefit from the IRS, we charge you a percentage of that benefit. So we charge you, our fee is typically 10%. So we're less than half of what other businesses charge in this space, because we want to make sure that you're getting the majority of your benefit. And if you have to pay, 30% in taxes, we don't want to, we want you to have the most of your
Gotcha.
of your benefit. Yeah, there are other companies that do charge more than we do. There are companies that charge upfront costs. There are companies that charge a flat rate. For small businesses, it's usually more than what you would be charged if you're doing a percentage basis. And usually when you're charged a flat rate, those rates are incremental based on the number of employees that you have. So it's a certain amount, we charge $5,000 if you're this number of employees, and then if you're over this number of employees, we charge, 15,000 or however it is.
So obviously, when you take a look at a company and you want to make sure they said, okay, yeah, we can help, and you're going to be able to save them money and get your percentage. What if you identify, said, oh, wait a minute, they're not going to get anything back?
Then our time is free.
Gotcha.
Our information is always free. So if you ever call us just to ask questions about this program, my number is right there on the screen. Feel free to reach out to me if you have any questions. I'm not on our sales team, so I'm just sort of expertise in the background.
Yeah.
But yeah, if you have any questions about anything like that, just feel free to call us. It'd be great if you could mention that you heard about us through the Asian American Chamber of Commerce, or if you provide your sources. That way we can say thank you to the people who are reaching out. But yeah, absolutely. I'm happy to answer any questions. Yep.
Thank you.
And now you have a wonderful partner, the Maryland Hispanic Chamber.
Oh yeah, that's great.
So it's hard to find the trusted kind of partner, and we're glad to have you as our partner. I'm wondering if Duke would like to share some words, because Duke has been working with us and offering supports, and we have lots of questions, so he always have provided support. And Duke is in this region, so he is always available, and he's there to support us.
Yeah, I think the important thing is to be able to identify, how we can help each other, right? There's going to be instances that you're going to need connections to create a program within your organization, and let's say we're already doing that, so we can guide you on how to do it, and vice versa, right? You're probably doing things that we're not doing, and probably adapt some of those programs and be able to also add that to our program. The main thing is to collaborate and be able to help each other, and really looking forward to it.
Okay. So I want to maybe take just 1 minute, share a couple of upcoming events we have. Also, this is kind of the Chamber program, Joseph Asia Summit. We have quite some mixers and joint events with many other chamber. Lunch with Leader series, different webinars, workshop, and government contracting programs, and international business series. We're organizing a trade mission to Vietnam next year around April time. So if you're interested, please send us a note. And we have culture series as a culture chamber. So this is a joint event. I know Marco, the Maryland Hispanic Chamber, we will be collaborating again. There's almost a dozen of different chambers in Central Maryland. This is exciting culture program with networking and delicious food, culture performance, and some wellness program there too. This is our joint events with the Arlington Chamber, August 10th in Arlington. And then this is our regular signature events at the KPMG in Tysons. It's a kind of big conference with keynote speakers, breakout sessions, and some trendy topic like innovation technology, GovCon, economic outlook, international trade, type of program. So wonderful members here. If you're not a member yet, we welcome you to. Thank you, everyone, and enjoy the rest of the day. And we're here to support. Feel free to contact us.